I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. During my investment journey, I started to wonder about why the rich don't pay any taxes, or at least very little taxes, and all us ordinary people, we do. I'm not saying it isn't fair, I'm just saying I was jealous that I got screwed and rich people seem to be able to get away with not paying taxes.
This is your wake-up call, pal. Go to work.
So I started to look into the reasons and how the really wealthy avoid paying so much in taxes. This was kind of interesting to me, especially now that I was about to enter the investment world. So how do they do it? Well, it's actually fairly simple. If you know what the government wants you to do and how they want you to do it, they will give you tax breaks. If you have the recipe for how to avoid taxes, it's literally written in the tax code. Yes, the system is rigged, but it's rigged to reward those who do the things the government can't or won't do, usually because it involves risk or it requires capital or a lot of work, and partially because politicians need to have money, and that money can only come from either investors or unions, who both want influence to get what they need. So the main principle is, if you don't earn money, you can't be taxed. Wait, what? But I want to earn money. No, you want to spend money. You don't necessarily want to earn money, especially when said money is being taxed. That's why the super rich like Elon Musk, Jeff Bezos, etc., they don't get a salary, they get stock options in the company. These stock options have a potential future value. Now they go to a bank and get the bank to issue a loan with these stocks as collateral. A loan is debt, and debt is not taxed. Let's say Elon Musk has 1 million shares in Tesla, and he got them for, let's say, $5 a share, which is not crazy. He has a theoretical value of the current stock price minus those $5. I don't know what the Tesla stock price is right now because it fluctuates like crazy, but let's just for argument's sake say the stock trades at $245 a share. Then he could have $240 times 1 million shares. That's $240 million value in his stocks. If he sold these shares, he would have to pay tax on the gains of those $240 million. But if the bank gives him a loan for, let's say, $200 million, with those $240 million of shares as collateral, he does not have to pay any tax. Elon Musk now has $200 million cash in the bank. He can spend it on whatever he wants to, and as it is a loan, aka debt, it's not taxed. Of course, the bank doesn't do this for free. They will charge an interest and most probably want some sort of a repayment plan. If the interest on that loan is, let's say, 2-3%, all Elon Musk has to do is invest enough money in something yielding enough to make the interest payment, and he can buy whatever he needs with the rest. As long as the shares appreciates, the bank is happy, and he can even borrow more later. And as he pays the interest and the stock doesn't go down a lot, he is the winner. Well, the bank is the winner too. Of course, there is risk here. If Tesla stock goes down and the banks want their money back, that could be a problem. But they most likely have some kind of agreement built in. But wait, doesn't he have to pay those $200 million back to the bank? Well, yes and no. The bank really don't care as long as they get the interest payments and the shares appreciate. They know at some point Mr. Musk will either have to sell some shares or pay off the loan. And worst case, if the market turns and everything goes to hell, they can sell the shares and get their money back. As long as the bank gets their interest payments and the shares don't go below the money they loaned, they're really happy. Now, here's the part people like Robert Kiyosaki keeps pointing out. Debt is never taxed, and that's because the government and banks use debt to create money. Here's the kicker. This method is actually possible for us normal people too. It all depends on the bank and how you do it. You could take out a loan on your investment portfolio and invest that money in, let's say, real estate. As long as you make the interest payments and the portfolio goes up by more than inflation, this is a good deal for everyone. Some brokers also let you leverage your portfolio. My broker allows me to use 50% leverage on my portfolio, so I can buy stocks or bonds for additional 50% of my portfolio value. But beware, this can be very dangerous if macro suddenly turns against you, so be very careful with this type of approach. Leverage is really something that can kill your portfolio. Another way of paying no tax, and maybe the very best way, is like Robert Kiyosaki does, and invest in real estate and rent it out. Robert Kiyosaki, the author of Rich Dad, Poor Dad, is known for having, I think, over 6,500 rental building.
The US dollar became debt. So debtors are the winners today. What I do is what the 1% do. So why the rich get richer is for those who want to be in the 1%. The rich don't pay taxes. And taxes in your lifetime will be your largest single expense. But they don't teach you that in school. I disclose how I do it, how President Trump does it, and all this. And we do it legally.
He uses the 4 types of quote-unquote people. An employee pays around 40% in tax. That's the majority of people. Get a job, earn money, save money. Hopefully, you one day will be able to retire, and hopefully there's something left in your 401k to live on. Yeah, let's see about that. Those are typical the very risk-averse, and they like the perceived security of a job. And it is only a perceived security, because you can easily get fired. You typically have no influence on the company you work at. You're not in control. Self-employed. They pay around 60% in tax. Doctors, lawyers, small business owners, etc. They can end up paying 60% in tax, both business tax and personal income tax. So they are actually worse off. Of course, this is generally speaking. Some have good accountants and will also use the tax code to their advantage, but generally speaking, they are taxed higher than others. Big businesses. This is companies with over 500 employees. And the reason they get tax breaks is they create jobs for the employees who will pay all the taxes. Now we get it. So big business, they're doing well. Now we come to the interesting part, the investor. 0% tax is possible. It's not always 0, but at least it's typically a lot lower than anyone else. Why do investors get these tax breaks? That's because we take risks, we provide something the government wants. Like I mentioned before, housing, jobs, etc. Now, which one would you like to be? How much tax would you like to pay? That should be a no-brainer. And even if you don't end up paying no taxes at all, you will be paying far less taxes than a normal employee, and more importantly, you will be able to speed up your financial independence exponentially. Regardless of what the leftist politicians are telling you, the government actually makes this possible by lowering your taxes using incentives and deductions. If you do something the government needs or wants you to do, they will incentivize you to do it. Create jobs, provide housing, etc. So how do we do this? And remember, we have to do it legally. Here you need a good accountant and/or lawyer who can help you find all the tax deductions you're allowed to use, especially when the tax laws are changing and you need to act quickly. So how does this work for a company? Well, we all have the possibility of deductions, but these are small and not very useful. If you really want to avoid taxes, you need to become a business and/or investor. Look into the different company types and find the one that's best for you. And if you should have a trust and a holding company, that's a whole other video. But you need to at least start an LLC, a limited liability company. It creates the entity that allows you to get the tax deductions. Remember, we're not taxed on what we earn, we're taxed on what we keep. Now that we have a company, that company has a lot of tax breaks and deductions. Let's say you have a company that makes $100,000 a year in revenue. You won't pay taxes on that $100,000. You would only need to pay taxes on what you keep. So a normal, simple income statement looks something like this. You can say a person, employee, they earn the money first, then they get taxed, and then they can spend the remaining. Yes, I know they get some small deductions too, but nothing to really speak of. In a business instead, it's reversed. A business earns the money, spends the money, and then we are taxed. So we can spend before we are taxed, as long as we spend the money on or within the business. The government rewards that. Now, what do I mean when I say this can really make you rich? Remember, there's still risk involved. That's why we get the tax breaks and why the normal employee doesn't. The employee doesn't take risks. Let's say I have a company owning real estate and renting it out. Let's say we have $500,000 in revenue 1 year. Now we have our direct expenses, loans, upkeep, property tax, etc. Let's just say there are 400,000. So now we would be taxed on the $100,000. But wait a minute. Here the government gives you a lot of possible deductions for running your business. They are not all 100% deductible, but they will add up. You could have an office and need to pay rent and utilities for this. This office could be in your main residence. Now you can deduct a part of this. You would need to have a car. You use it for business use. That's a deduction. Some states let you deduct the whole car purchase and the use of it. And we definitely need that company car. You would need computer, phone, recording equipment, etc. Whatever you need to run your business. Deductible. Advertising, which gives your business more value. Deductible. Education, which can improve you and your business. Deductible. That education could be almost anything and anywhere in the world, and you would need to get there. See the point? Insurance, other expenses, everything in your business. Now, this is where we come to the fun stuff. Business trips. I go on business trips with my business partner, which happens to be my wife. Last year we went to Hawaii, and yes, we did look at properties and we did have meetings with people, but we also had our kind of vacation. We were able to deduct the trip, rental car, parking, meals, hotel, all expenses related to this business trip to beautiful Hawaii. We need to have business dinners. Sometimes when we go out for a nice dinner, we deduct 50%, or we have a business dinner with our employees, then we can deduct 100%. We can deduct a plethora of things, and all of these are expenses you would need to have as a business, so it makes sense that they can be deducted. But here comes the kicker. When operating rental properties, there's something called depreciation. Almost anything depreciates in the eyes of the IRS. All business assets will depreciate and has a standard formula for depreciation. And know what? You need the stuff anyway. Furniture, computer, phone, car, etc. But wait, there's more. As our business is real estate, there is a standard depreciation percentage on the value of the properties you own and rent out. Note, only on the property, not the land value. Why? Well, the renters wear on the property and you will eventually need to have some expenses to fix it up. And the fact that the property almost always appreciates has nothing to do with this. Win-win. And remember, even if we depreciate the whole building, the building will always have value in the market, and that's never zero. This is one of the real interesting parts of real estate investing. Let's say we buy a rental property for 1.3 million. We don't have that money, so we need to borrow it from the bank, using debt. Maybe we have the down payment, maybe we don't. We could borrow that from other investors, etc. Now we have the building and rent it out. Let's say it's a 3-unit, 4-bedroom, and we rent them out for $9,600 a month in rent, giving us around $115,000 a year in rent. We have a loan, costs around $73,000 a year. We have other expenses for around $17,000, which also are deductible. And we set $10,000 aside as a buffer every year. There could be periods without a tenant. We forget about everything else and just focus on the simple calculation. Rent in, $115,000, expenses, $100,000. Our income is $15,000 a year on that property. However, here comes all the deductions I mentioned before. The company, the depreciation, everything. Let's just stay with only the depreciation. We get to depreciate that building with 3.64% every year for 27.5 years. That's a tax deduction of $36,360 every year. Now the math looks like this: 115,000 in revenue, 100,000 in expenses, 15,000 in income, minus depreciation of 36,000. We are left with 15,000 in the bank, no tax paid. And we also have further $21,360 we can earn before paying any tax at all. So any other income is not taxed. And it gets even better than that.
What the shit?
Let's say we let some time pass by, and in 4 or 5 years, we upgrade the property, washer, dryer, maybe new kitchen appliances, something else. Now the property has a higher value, and we can up the rent, and now the property has more value and income, so we can refinance it. Let's say the property value is now 1.5 million. The bank will again lend us 80%. That's 1.2 million, which means we get $300,000 in cash, again, tax-free as it's debt. And we can use that money to finance another building. And we're off to the races. Rinse and repeat. The renters still pay the mortgage, and we get the amortization, the appreciation, and the deductions. This appreciation is ours, tax-free, as long as we don't sell it. Even if the bank actually owns the majority of the building, we still get the appreciation. Nice. What's the catch, you say? Well, the catch is the whole process of finding the real estate that can eventually become a good investment. Buying the real estate, using debt, adding risk, owning it with the renters, adding work, adding risk, adding hassle. But when we get to critical mass and have a lot of real estate, we will typically have a property manager, maybe some contractors on hand, and all the other people we need to keep this business going. And we can do whatever we want instead. We have people making money for us. As long as we don't sell the properties, this is a good strategy, and the term is called buy, borrow, die. You buy assets, borrow against those assets, and when you die, your heirs benefit from the step up in cost of those assets. And once they receive them, i.e., no tax to pay. That step up allows them to avoid any capital gains tax on the assets as they inherit them at the current value. The other option is for a trust to own the holding company, which own the properties. Your children could operate the trust and the assets and don't sell them. Should they decide to go that route, they can continue implementing buy, borrow, die until the next generation, and so on and so on. This is how generational wealth is created. Just to get you started, I will give you a bonus tip. The only thing I ask is you hit that like button and maybe even subscribe. Did you know that if you buy a property like the one mentioned with 3 units and you decide to live in one of them, then you only need to put up 3% in down payment instead of the 20%. As this is now your main residence and you're renting it out. After a year or 2, you can move out and rent that one out too. And let the renters pay for everything. And now you got started with far less money than you imagined, only 3%. I will leave it up to you if you decide to look deeper into this. Just remember, real estate investing and equity investing are the 2 main pillars of wealth for normal people. So remember, the best investment you can do is in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the night inning. There ain't no point in resisting.